Hello everyone, Joe Mass here. It's that time of year. It's time to do a market review, so let's get started. So you've seen this slide before. It's the story of risk on and risk off, or heads and tails. And on the left-hand side, we have half the investors that are still concerned with the macro geopolitical risks. And then on the other side of the coin, we have investors that are, still worried about fighting inflation. On the left-hand side here, the risk-off strategies, they're maintaining diversification. Bonds have been starting to do better. And risk-off assets, although they're going to have lower returns, are providing protection to the portfolio. Asset allocation's working. It's performing as expected. And so people are going to be pretty happy with that side of the coin. However, for those of you who want to fight inflation, equities and growth are back, right? Growth, and we're going to look at that. Growth's back over value. The fourth quarter, except for December, was pretty good. The first part of 2023 has been off to a great start. And so risk-on assets are in favor. Now, that may not maintain throughout the year, but right now, things are much more bullish than they have been. So we had a strong fourth quarter. It's been a good start to 2023. Today is Valentine's Day, February 14th. So happy Valentine's Day to everybody. And again, year to date, the markets are off to a really nice start. So we'll start with a quick review. On this next chart, we're looking at 59 different asset classes, and you're going to see that only 15.25 were positive in 2022. Now you'll look at the two columns here. There's one column that says the fourth quarter and one column says 2022. You'll notice that in the fourth quarter, there's only number 46, 58, and 59 had negative quarters. So the rest have had a pretty positive quarter. Although the year ended up negative for most asset classes, the fourth quarter was strong and the markets were happy except for December. Okay, so lots of green to end the year and lots of green to start the year. When we look at our portfolios, everything's working the way it's supposed to be. Fourth quarter, we had good returns from our dividend portfolios, our metals portfolios, our faith-based portfolios, our real estate portfolios. All of our portfolios performed very well in the fourth quarter. For the whole year of 2022, we actually had our dividend portfolio that was positive. The index was negative and most things were negative, but we were able to have some positive returns with our dividend strategy, and we're thankful for that. Again, when we look at our asset allocation portfolios, which are our sailboats, are really our defensive portfolios that can also short the market, you'll notice that the fourth quarter, they were all positive, but barely positive. So why weren't they up more when the market was up and the fourth quarter was strong? Well, remember, the sailboats are tactical, right? They got us through the year, and you're going to see in the next slide that they ended the year very well, but we're still using cash. We're still shorting. We're not out of the woods yet. We're still worried about balancing the portfolio and hedging the portfolio to be risk on and risk off. When the market runs, these portfolios are, their asset allocation, they're not going to keep up with an all equity portfolio. In fact, they're not going to keep up with a more traditional asset allocation because of the short. We do have the tugboats and the speedboats, which are more traditional asset allocation, and those are going to be more like the indexes, okay? So as you can see here, the sailboats for 2022, the moderate model was down 4.8, the aggressive was 4.3, the conservative was down 4.73. The market was down 18. The iShares moderate was down 14. Moderate iShares aggressive allocation was down 16. The group was down for active managers in that 15 to 30% equity category. It was down 10. So again, last year, the sailboats performed very well because we did have cash and shorts on the market. Let's move into the next hot topic, which is a recession. What drives the recession and expectations? We're going to go through some of the facts and data that we're looking at. But, at the end of the day, we don't really know. We don't know if or when. We don't know how long. We don't know how deep. And we don't really know what the Fed will do. We know what the futures markets are telling us. We know what the consensus estimates are. But no one really knows what they'll do. But let's talk about what we do know. We're going to look at the unemployment chart here. Now, again, like we talked in the past, there's no level of unemployment that really predicts a recession. Like if inflation gets to 5%, we're going to have a recession. Or if inflation gets to 3%, we're going to get a recession. But what's more probative of a recession is really that rate of change, that 1 year rate of change in the unemployment rate. And if you've seen in prior videos that the red bars are recessions, and when the blue bar, the net 1 year change in unemployment, goes from 0 to 1%, right, then that recession has been following, and it's never had a false positive. So here we can see that we're not back up to zero yet. Unemployment is still very low, even though the Fed would probably like to get it up to 4 or 5%. And there are a lot of tech companies laying off people right now. It's still been historically low. So we're watching that. And if that gets up to zero and then gets up 1% from there, that's a strong probability of a recession to follow. The next thing that we're going to look at are some different recession models. So on the top chart is S&P 500. The middle chart is the New York Fed's probability model, and it's sitting at 57% chance of a recession at the moment. And the bottom panel in the gold color is the Bloomberg model, and they're at 100% probability of a recession. And I think, there's people out there that think we are in a recession, and so there you go. That index would be for you. That's 100% that we will have or are in a recession over the next 12 months. On this chart, again, we're looking at the Fed probability model. They're really looking at that 3-month and 10-year Treasury spread. And so it's replicating selling the 3-year month U.S. Treasury bill and buying the 10-year U.S. Treasury note, then factoring the differences by 100. So here we can see that it's below a zero. And so that is showing, as we're going to see in a few slides, an inverted yield curve. That's not a good sign for the economy. That is a sign of a recession. And again, the Fed has that at about a 57% probability of a recession. Now, when we look at all the models out there, the probability of a recession is, the mean is 65%, the median 65%. So this is data from Bloomberg, where they're looking and surveying all the contributors that they have and seeing where the range of forecast looks like. So it's a pretty good looking bell-shaped curve here. So just, pretty equal distribution, but this is showing a 65% probability of a recession. So the Fed's at 57, the consensus estimate's at 65. So again, some pretty strong probabilities of a recession. And we'll talk more about if it does happen, will it be shallow? Will it be deep? And so we'll talk more about that. Before we get to that, here's where we're looking again at what happens with the Fed pauses, right? And so what we know is that when the Fed pauses, there could be contraction. And if that contraction happens, it's because the ISM indexes, both the manufacturing and services indexes, have broke 50, which is in a contractionary indication. Anything below 50 is contraction. Anything above 50 is an expansion. So right now, the Fed funds rate's about 4.75. It's coming up. And, if we see a pause, what we would want to see is the markets continue to go up if the indexes don't get into a contractionary area. But if these ISM manufacturing and services indexes stay below 50 for very long, then there's a higher probability that we will dip into a recession and we won't have a soft landing. So the next question that really follows is, when may the Fed pause, right? And so what we're looking at here in the bottom graph is we're looking at the Fed funds target rate and then the core PCE, which is a measure of the Fed's favorite measure of inflation, year-over-year change in the white. So you can see that inflation has come down to 4.41 on the PCE, and you can see the Fed funds rate have come back up to 4.75. That's looking really close to a pause. Today, we actually had inflation numbers come out that looked like inflation ticked up a little bit last month, but in general, there's been a lot of deflation happening. So we're still watching that. We're not out of the woods yet, but if the inflation rate continues to drop below, that white line drops below that orange line significantly, the Fed is most likely going to pause. So the next piece of evidence that we can look at about whether the Fed will pause or not is the Taylor rule. And the Taylor rule is just an academic model that kind of predicts where the economy should be so that it wouldn't be contracting or expanding. And so that right now is at 9% when we're at 4.75. So, there's definitely more room for the Fed to go up, probably get up to 5 or a little bit over 5, which we'll see from the dot plot in a few slides. But, there is an error in the model. The model's not perfect. And so there's, there could be a 2 or 3 point error in that model. So if there was a 3-point error, we're getting to 6. We're probably going to get close to 5. So we're moving in the right direction for the Fed to pause. When a pause happens, typically there's a rally, and then there's a sell-off if we slip into a recession, right? So we've seen this before. So here we see a pause. The market down here on this white line rallies, and then the ISM indexes were in a contractionary area. We hit a recession. Same thing here. Pause. We did get a little rally, and then we get this contraction economically, and we get the recession. So we don't know what's going to happen here. We're still watching. We still have to wait and see. But you'll notice that we're getting probably close to that pause. And the service index actually broke 50 and then really shot back up. And the manufacturing index is still down below 50. But we're, again, this is a confusing time, right? The markets and the economic data is confusing. There's not a lot of clarity. None of us know what's going to happen. It's very confusing. There's lots of data on both sides of the coin. And so again, it's nice to see this come back up. It's nice to see the manufacturing, the green line, only at 47. It's not at a significant low. So there is hope of a soft landing, and we'll just have to wait and see what happens. Okay, let's turn our attention to what drives the market. So as you always know, we like to talk about inflation, interest rates, corporate earnings, the Fed. Those are the main things that drive the market, and of course, the geopolitical events. And we're going to have some elections next year. We got some the debt battle probably happening this summer. So there's some things that could happen. We're shooting down spy balloons now like every other day. So, there are some geopolitical tensions out there, and we'll just have to wait and see what happens. But, we're hopeful that the markets will not overreact, but we just have to wait and see what type of geopolitical events unfold. So here, looking at inflation, we see the red line on the top panel is where the Fed's target is. The white line is the University of Michigan's 5 to 10-year inflation outlook at 2.9. And then we have PCE annual inflation coming down again here at 5. When we look at the University of Michigan's next year median, the top graph is the long term. The short term is the purple line. It's about 4.2, ticked up a little bit. The CPI is at 6.5. It had a little tick up announced today. So that's inflation. So we're all feeling it. It really depends on what your basket of goods and services are that you like to buy in your life. I like eggs, and eggs have doubled. I'm not happy about that. But we all have an understanding that inflation's here. But again, some of it is starting to come back down. So the Fed's done a good job right now. It's still got more room to go, and we're not out of the woods yet. But inflation is not as bad as it was at the peak. When we go to interest rates, we're going to start looking at the 10-year rate, and that's in the white line here. And the S&P 500 is in this kind of cayenne line. And you'll see that when these rates were coming up, the market inversely fell, right? Rates go up, market's been falling. Rates started to come back down here. Market started to rally. You can see here the rates kind of went sideways. There's a pause, and then you can see that pause generated this run up in the market. And then rates took off again, and that market dropped again. So there's that inverse relationship that we're seeing right now between the 10-year Treasury and the United States 10-year Treasury bond. So another way to look at rates is the yield curve. And as you can see here, it is negative, meaning that the short-term rates provide a higher return than the longer-term rates. So again, the 3-month Treasury bond is at 4.75, and the 30 years at 3.8. The 1 year's at 4.88, and the 10 years at 3.74. So this has been good for investors to get some Treasury bills and some yield out of your money markets, but we don't like this long-term inversion for the overall health of the economy. So one thing to look at here is the 2-year Treasury yield and the Fed funds rate. And you'll notice here that the Fed funds rate in this orange line is just a little bit below Fed funds of 4.62. So you see that negative spread represented down here in the bottom panel by this red. So they're really close. Again, maybe a pause is coming, but the 2-year Treasury yield and the Fed funds rate are now just about at the same point, at an equilibrium point. When we go to the Fed and looking at the dot plot, remember, where should rates be? We can see that so there's probably going to be another rate increase or so coming up, another 25 bips once or twice. And that's where the Fed thinks rates are going to end 2023. And so here you can see this white line is the Fed's latest value. The green line is the median. And this blue line is the Fed funds futures as of the last meeting. And so no signs here that the Fed will start reducing rates in 2023. But you can see that after 2023, that the backside of 2023 is looking that rates could come back down. So I don't know if they're going to come back down this year. It doesn't look like it from the evidence that we have right now, but we'll keep you posted. But that is, again, we have to have that pause before that can start coming down. And again, it's looking like we're getting closer to a pause, and that the rates might start coming down next year. So now let's turn our attention to earnings. We looked at inflation, we looked at interest rates. Now let's look at corporate earnings. So corporate earnings right now are projected to be negative. On the bottom panel here in the green bars, we have the trailing 12 months earnings per share in the S&P 500 at 223, and the blue bar is the consensus best estimate of where earnings are going to be, and that's at 209. So if you take the difference between 209 and 223, you get a negative 6% expected growth rate on earnings. Okay, so let's talk more about earnings. What we're looking at here is the S&P 500 prior quarter here, and we are looking at the surprises. And so all the securities in the S&P 500, at this point, 347 out of 500 had reported, and there was a little bit of an earnings surprise, at 1.5% overall. Now you can go down and look sector by sector at who's reported and what their sales surprise was and what their earnings surprise was. And so you can see industrials were negative, communications were negative, but consumer discretions, those earnings surprises were up quite a bit. And same with materials and healthcare. On the next slide, we're looking at the growth of earnings. So here's corporate earnings growth. And so you'll see again here, based on what's reported so far, that we have some negative earnings growth. But there's some bright spots. I mean, industrials had a good earnings growth. Energy had a good earnings growth. Consumer discretionary was positive 22.32. Utilities and real estate. So again, there are parts of the market that are still having, some pretty good earnings growth and surprises. So that's promising. It's not as bad as it could be. It could get worse. And we do expect earnings to come down a little bit. But overall, earnings, look like they're hanging in there. This is just another way to look at the data that we just looked at. It's just an easy way to look at it, that we've had a negative fourth quarter in the consensus estimate, down 1.7. Again, the data will be off a little bit. Different providers, different dates here as I've been putting these slides together. But here we're looking at 345 out of the 500 companies that have reported. So 69% are beating, 31 are missing, and 2.2 surprises. So again, not as bad as it could be for the verge of a recession, or some saying we are in a recession. And then looking at the composite estimates that we put together, I'm using the Zacks data. We would look for 5% earnings growth going forward, 6.9. So again, maybe we get a normalization in that earnings growth. Again, no one knows. These are estimates. This is just data we're trying to look at. So earnings, the story is that they're a little better than expected. They're holding in there. And again, it helps our active management as we pick stocks, because we can really look for the sectors and the stocks that are still maintaining earnings, and that'll help us get through the volatile times. And we have evidence of that in the dividend portfolio that was, again, positive last year, 3% or whatever I showed you when the market was down, 18 or so. So continuing our earnings discussion for a few more slides, what we're looking at here, again, is that trailing 12-month earnings on the S&P 500 from the other slide, that 223. And the S&P 500 is the white line. And so you can see the correlation is that pretty much earnings have been driving this market, right? As earnings go up, the market's going up and following it. Here we saw that earnings flatten off and drop for COVID. And then we see earnings really taking off. The market followed. And now earnings right now are a little bit ahead of the market, right? We've seen the market pull off, so there's some divergence right here in that, and that's because these earnings may start to become negative. They may not have been revised down yet, so the market has pulled back even though earnings have continued to climb. So in this case, maybe the market's ahead of the earnings, okay? That's the data that we're looking at. And I think the next slide is really interesting. What we're looking at here is that when it comes to corporate earnings, the market usually bottoms first, right? Which is kind of what we started to see on that last slide, right? When we saw that the earnings continue to go up and the market to bottom, and that kind of decoupled from the historical perspective from that prior slide. So what we're looking at here is the white line is the S&P 500, and the blue line is the trailing 12 months earning per share. So you'll look that here on this yellow line that the market, right, bottomed before earnings did. In fact, when earnings bottomed right here, the market had already started to recover. Again here, the market dropped, then earnings dropped, and the market started to recover before earnings. And so there is some hope that that repeats now, that the market has bottomed, and even though we think earnings have some turbulence ahead, if we look at this data, it may not be as worrisome as you might think. This slide is kind of evidence of that. This data shows that the S&P 500 bottoms 11 to 12 months before earnings per share bottom, and we just saw that in the prior graph. So there are times that's not true. Here the market bottoms after earnings per share in 61. Again in 87, the market bottoms after earnings per share, and again in 2002, the market bottoms after the earnings per share. But equities bottom 11 to 12 months before earnings per share. On average, there's that 12 months and 11 months on the median. Again, some hopeful points in the data that we're looking at. So what does this all mean? How do we put all that together? Well, based on where the market is today at 40.90 and where the consensus estimate is going to be next year at 45.84, that gives you a positive return on the S&P 500 over the next 12 months of, a little bit over 12%. Okay? So again, asking that question, does the market make sense? How do we rectify this? Because a lot of people are going to know, well, if we have negative earnings growth of 6 and we have dividends rounded off to 2, shouldn't we have a negative 4% return? And so over here, we're decomposing the returns of the market over the last 20 years. And what we're looking for is really to see what that PE expansion multiplier or contraction might be. And so again, what we're going to have to see here is that to get to a 12% return, if dividends are going to be 1.8 and earnings per share are going to be negative 6, then we have to have a PE expansion of 16%, 16.28% to be exact, in order to get to a 12.8% expected return. So over the last 20 years, we can see that the PE expansion has really been only just barely positive, basically zero, right? Over the last 5 years, it's been negative 5. Over the last 10 years, it's been 1.8. In 2022, it was negative 16. In 2021, it was negative 41. So it is within the range that we could see that with a 16.28% PE expansion. So that's what we need to have. So on this slide, what we're looking at is just more evidence to see if that 12% return makes sense. And so what we're looking at here is we're looking at the white line is the forward-looking PE of the market. That's just a valuation measure. And then we're looking at the index, the current PEs in purple. And so you can see that they're pretty much the same, which means that we could have a flat market, and a lot of people are expecting a flat return this year. So what we normally want to see is we want to see next year's PE ratio lower than this year's PE ratio. And that's because we're assuming price stays constant and we want to see earnings growth. So if earnings are going up, then that's going to bring that price to earnings ratio down. And that's what we're looking at this chart. On the top line is the best 12-month expected PE ratio of 19, okay? And the blue line is the best earnings per share. So you'll notice that the earnings per share are have been coming down, and that PE is coming up. So again, what we want to see is we want to see this PE ratio coming down, and in order to see it coming down, we'd have to see earnings going up. So based on the prior slide, the current PE and the forward PE are basically the same. And so that would basically indicate that there's no earnings growth or earnings contraction. Okay, just another piece of evidence. So now let's turn to the outlook. So over the next 12 months, currently right now, we're somewhat bullish on equities, right? We've put some cash back to work. We took off the shorts where appropriate. International is outperforming the domestic, and we've overweighted to that. Emerging markets are looking good. China's been one of the best trades over the last 12 months, and the Chinese technology still looks good. Now, I think the world's not very happy with China right now because of the weather balloons and all the geopolitical issues. So we'll have to watch that. I still think it's a risky market to go into, but it has been performing. So again, looking backwards, it's been performing. Looking forward, we need to be cautious. But the numbers, the math are showing the international and emerging equities are pretty strong. For the U.S. fixed income, we took the short off, and we're still probably neutral on that market. As the same with real estate, we're neutral on the real estate market. So we're bullish, we're neutral, we're still hedging. We don't think we're out of the woods yet, so we're not going 100% equity and we're not going 100% short. We're still very cautious. We're still expecting lower long-term rates. Risk versus inflation is going to continue, but inflation is falling, although we did have a small tick up in inflation on the last report here today. The old adage of don't fight the Fed is important. I mean, the Fed may be coming to a pause. Again, we saw that chart earlier where the evidence presented itself in the 2-year Treasury lower than the Fed funds. The interest rates, we do have a negative yield curve. That's not a positive for the economy, but a soft landing is still possible because of those ISM indexes not being significantly below 50, and economic activity seems to be holding in there, right? The increased opportunity for active and tactical management in asset allocation and stock selection is still there, and we just need to be patient, right? We can't outguess the market. We can't time the market. We need to base on sound fundamental principles and technical analysis and looking at the preponderance of the evidence. So again, remember, the economy and business cycles, right? And so what follows a downturn is an upturn. So at some point here, there are going to be opportunities, and that might be in 2023. People might want to start averaging back in. Again, not out of the woods yet, but at some point the market and the economy are going to turn, and the market currently has been in a pretty bullish stance. Again, it's pretty difficult to understand. It's confusing to understand. I wouldn't have expected the market to be as strong as it has been. So again, we got to be patient. We're not going to try to jump in or jump off the boat too fast. We're going to just be patient and prudent. Remember, we're looking for reasonable returns with reasonable risk over reasonable time periods, for reasonable people. We're not trying to time the market. We're not trying to hit home runs every day. We're trying to win the game, right? Hitting doubles and singles. Again, looking at 2 years of negative equity returns is possible. Last year was a negative year. It's possible that it happens this year, but unlikely. So again, it's possible, but I would like to think that it'll be flat to slightly positive. Risk management is once again a popular strategy, and that's been boding very well for us. Again, when the market turns and the economy turns and we establish a new bull market, risk management is not going to be in favor. You're going to want to be tilted to equities to take advantage of that. So just keep that in mind. Again, corporate earnings may hang in there. There's a weaker US dollar, bottoming in the PMI index. The supply chains are better. China's COVID policy has been relaxed. So, we could see some higher corporate earnings in 2024. Again, maybe not this year, but by 2024, the data is looking like we could be back on an upswing. And then again, watching the labor participation rate, the fiscal policy, right? The tax and spending is an issue, and then unemployment. Those are things that, again, this is confusing. We got to watch all of this. Unemployment is still historically low. We know the Fed wants it up. There's going to be talk about taxes, but with a split Congress and Senate, I don't know if we're going to get them. The current administration, they want to spend more money. So the fiscal policy will be something we continue to watch. What should you do? Well, hold enough cash to make you comfortable. Evaluate your time horizon and other factors that go into your investment policy statement, right? So if you have a long-term perspective, you can handle more equities, okay, more volatility. If you have a short-term horizon, you need to have more risk management, more bonds, and more cash. You need to communicate your changes in your objectives and constraints. Again, all of our portfolios are doing well, both absolute and against their benchmarks. And we can get you into a different portfolio if it's not the right one for you. So we have plenty of tools, plenty of portfolios. Make sure you're communicating with us if your risk or return objectives have changed. And then we still have to be patient, right? We're in the middle of this. We're not at the end. We're not at the beginning. We're middle to the end, and we still have to be patient. And that's hard to do, right? So what are we going to do as a manager, right? Well, we're continually managing cautiously. We're monitoring and adjusting. We're always recalibrating. We're always looking at the data. We're trying to communicate this the best we can to you. We've been very busy, so we haven't communicated as much as we would have liked to over the last 30 days, but it's been year end and the markets are crazy and we're rebalancing portfolios. And so as analysts, there's 3 things that we do. We investigate, we analyze, and we communicate. And we've been busy investigating and analyzing, and now I came up for some air to communicate. So we'll continue to do what we're doing. We're happy with what's prevailing from our processes. Again, we're process driven. We're going to maintain that. Okay, so for those of you that would like to stop the video now, please do so. We've gotten through the majority of what we wanted to talk to you about. For those of you that would like to look at a few more detailed slides, we're just going to go through part 2 here real quickly. And so you're welcome to stay, and we'll just share a little bit more information with you. The first observation we want to share with you is growth stocks versus value. The blue bar is when it's up, it means growth's in favor, and you'll see that growth has come back in favor right now. Okay, this year it's starting to come back. And so again, The dividend portfolio did really well last year, and we were recommending kind of, a split between the dividend portfolio and the growth portfolio. And we're continuing that same split. We're just starting to see more return come from the focused growth portfolios as opposed to the dividend and the value. Okay, so growth has come back a little bit. When we look at large companies versus small companies, here, when the purple line is up, it means the large companies are in favor. And when the purple line is down, it means that the small companies have been in favor. And so, again, we're seeing the year start off where the small companies are in favor. When we look at the market as a whole on the next slide, we see that the market equal weight and the market cap weight year to date are just about the same, right? And so you can see here each sector, whether it's favoring the equal weight or the market cap weight. And so this is something else that we pay attention to and we monitor, because in some of the portfolios we're going to optimize, in some of the portfolios we equal weight. And so this gives us comfort to know that we're repositioning the portfolios correctly. When we look at the sectors, we just want to look at the fundamental ranks. Right now, we're looking at 4 factors here to combine them and make a ranking system. We're looking at the 12-month PE estimates. We're looking at the next 3 to 5 year growth estimates on earnings per share. We're looking at the price to book and debt to capital. And so you'll see that we have energy ranked number 1, telecom, financials, materials, then healthcare, industrials, consumer discretionary, utilities, information, technology, real estate, and the consumer staples. So those are the sectors fundamentally that are ranked. And again, we use this to make better portfolio decisions and our tilts and our awareness of how to position the portfolios. The last slide we'll look at here really quick is probably the most complex. That's why I left it for the last. It's the VIX, it's the fear index. And so what this tells us is, based on volatility, how the market might move. And so when we're looking at right now the VIX at 2053, over the next 240 days, that equates to about a 20% move. We don't know if that's up or down though. So if the market's at 4090, that move's going to be 819. And so if it went down, we see a range of 3270 on the S&P 500 up to 4909. If we want to look at actual volatility of the S&P 500, that's a little bit lower at a 16% move. And again, starting at 4090, going down 660, or almost 665, that gives us a downward range of 34 and an upwards range of 4754. Now, if we want to look at the one-day move, VIX is showing a one-day move of 1.29 on the S&P 500, and then the internal volatility, or the expected volatility on the index directly, is a move of 1. So again, we still have some volatility. We've mentioned in the past that recessions, we don't really see them until VIX hits 40. So it's another piece of evidence that the markets have volatility somewhat under control right now. But we do expect a move 1%, 1 to 1.5% each day up or down in the market. So don't be surprised when you get up and you see your portfolio going up or down, 1%. That's what the market is expecting. So again, we use the VIX as an indication of volatility, and it gives us an idea of the range of how the market might move, and lets us know and collaborate the rest of our evidence to see if we think that those returns make sense. So again, with a consensus estimate of a 12% return on the S&P 500, it's well within the range of the move of 16%, and so that's not an abnormality, okay? It's not an outlier. So with that, we'd like to thank you for listening. I was happy to get this done in 40 minutes for you. I know I kind of went fast in some of this, so please, if you have any questions, just reach out to us. We'd be happy to walk you through, or have one of our analysts walk you through the data a little deeper. Again, we really appreciate you. We're having a lot of fun in these markets. We're working extra hard, but it's what God gave us to do. So we're blessed to have a job, and we're blessed to be able to take care of you, and we're very thankful for that opportunity. So again, stay calm. Make sure you've got a good integrated financial plan with your investment portfolio, and reach out to us if you have any questions. So with that, happy Valentine's Day, and we thank you very much.